Welcome and thank you for joining us. Today we're going to talk about unlocking hidden value for both employers and their employees with a tax-advantaged benefit strategy. By way of introduction, my name is Christine Andrus, Corporate Employee Benefits Director of Special Projects at USI. I am a career employee benefits consultant with over 20 years of experience in client advisory consultant and operational leadership. Today, I'm a member of USI's National Employee Benefits team, focusing on product innovation. Joining me today is Doug Lemondola. Doug is a national retirement practice leader for USI's defined contribution consulting practice. With over 25 years of experience, Doug leads consulting services in investment advisory, plan management, benchmarking, employee education, plan design, and compliance. His practice specializes in developing effective retirement plans that maximize benefits, control costs, and support strong employee engagement. Let's jump in. I'm sure it's no surprise to you that rising costs is the biggest benefit issue facing employers right now. Over the last 3 years, employers have seen the biggest consecutive year-over-year health cost increases in a decade. For 2026, employers are shifting away from no change to benefits towards spending strategies that enable allocation and recalibration of benefits. In short, escalating healthcare costs demand smarter spend management. As we head into 2026, employees and employers are in agreement on what their top benefits are: healthcare and retirement. While employers generally see healthcare and retirement benefits as one, the broker industry has traditionally managed them separately. Traditionally, health and retirement benefits have been managed in separate silos, leading to missed opportunities for both employers and employees. This approach doesn't support a holistic benefit strategy. Employers that use separate employee benefits and retirement consultants are most likely missing these opportunities. One key example of a missed opportunity is the optimization of tax advantages across all benefit plans holistically to avoid unnecessary payroll liability. At USI, we call this tax advantage benefit strategy. For most employers, the emphasis on tax advantage benefit programs has historically been placed on the reduction in tax liability to the employee. More often than not, little consideration is given to the 7.65% FICA taxes that employers pay. What is USI doing differently? Doug, let's fill them in.
Thank you, Christine. At USI, we've reimagined how employers can integrate their health and retirement benefit strategies to reduce tax liability, boost employee engagement, and enhance financial wellness across your workforce. USI's integrated consulting model embeds retirement expertise within our employee benefits team. This alignment enables our tax advantage benefits specialists to help employers design and implement comprehensive benefits strategies. HSAs offer a smarter way to save for health and for retirement. When employees think about saving for retirement, they often consider a 401k plan as the best option available to them. And while a 401k plan presents advantages with regards to employer matching contributions and higher contribution limits, saving in a health savings account provides for unique tax incentives. For example, did you know that HSAs allow employees and employers to avoid all federal and Social Security taxes, whether the money is used to pay current medical expenses or save for the future? With an estimated $172,500 of healthcare costs in retirement, most employees will need to employ multiple financial vehicles, such as an HSA and 401k, to ensure optimal retirement readiness. As illustrated in the chart on this page, HSAs offer powerful advantages such as the triple tax benefit: no taxes going in, no taxes while growing, and no taxes coming out for qualified medical expenses, and flexibility after age 65. When using HSA funds for non-medical expenses, withdrawals are taxed as income in the same manner as a 401k withdrawal. So if I'm an employee with access to a range of tax advantage accounts like HSA, 401k, and so on, is there a strategy to optimize savings? It turns out the answer is yes. Let's walk through it now. We've listed 4 strategies here in order of priority for optimizing an employee's next best dollar spent to leverage tax advantage benefit programs. The first 3 focus on saving for retirement, but in order that you may not expect if you've been thinking about HSA and 401k in separate silos. The first priority should be receiving any free money that is on the table from employers in terms of matching contributions. This would include employer matching contributions made to a health savings account and/or a 401k plan. All employees should take advantage of these programs with a minimal goal of saving enough to receive the full match. For example, if an HSA offers a dollar for dollar match on the first $500 saved, then an employee should be saving at least $500 into the HSA to receive the full match. The same strategy would apply to the 401k plan. After maxing out the matching contributions in these plans, the second priority should be maxing out an HSA to take advantage of the triple tax advantage. As I just mentioned, HSAs offer the ability to save for current medical expenses and also for retirement. Many individuals do not think of the retirement savings aspect of HSAs. The third priority would be saving for the future in both a 401k account and also in an emergency savings account or 529 plan, if available. From there, employees may want to consider tapping into tax advantages on eligible dental, vision, and dependent care costs that would be spent out of pocket by leveraging a limited purpose health flexible spending account and/or dependent care flexible spending account, and then protecting assets by utilizing supplemental insurance. We understand that employees may not have the income available to take advantage of all of these options, especially early on in a career. However, to the extent that they can, we think it is important for employees to utilize the strategies listed in the order on this slide to get on track for retirement readiness, especially viewing an HSA together with a 401k. Employers should encourage this holistic view of all available benefits from the perspective of saving for retirement. So, Christine, what steps should an employer take to allow employees to access the savings opportunities available in an HSA?
Well, first of all, what if an employer doesn't have a qualified high deductible health plan or QHDHP in place today? If that's the case, we at USI can help you design a plan that meets your needs. In fact, if you already offer a high traditional copay plan or PPO alongside a QHDHP with HSA, we encourage you to explore transitioning the high PPO to an actuarially equivalent QHDHP. This strategy would allow both employees and employers to benefit from HSA tax advantages, including avoidance of payroll taxes. Another strategy employers offering a QHDHP should consider is implementing an HSA match strategy instead of an HSA seed. Employers who provide a flat dollar amount to seed an employee's HSA fail to encourage employees to contribute their own funds to an HSA. Often employers can increase engagement with HSAs by migrating from a seed-only strategy to a dollar for dollar match only to a cap strategy to encourage greater participation. This type of contribution strategy can retain most of an employer's QHDHP cost savings. Now, a quick reminder on the advantages of an HSA. Number one, both employer and employee HSA contributions are exempt from payroll taxes. Two, HSA funds are fully owned by the employee and never expire. And three, since HSA funds can be invested similarly to 401k funds, employees may allow their account to grow over time and use it to pay for qualified medical expenses in the future. So, what's the near-term financial impact to the employer? That depends on how much you can increase engagement in the tax advantage benefits your organization offers. We estimate that an employer with average participation in their tax advantage benefit plans can save between $300 to $400 per employee per year in payroll taxes avoided. For an organization with 100 employees, that's $30,000 to $40,000 in savings. Employers who are able to experience high levels of participation across their tax advantage benefits may be able to achieve savings in the range of $500 to $600 per employee per year. And last but not least, it's important to note that for each employee who chooses to max out their HSA, FSA, and transportation contributions, the employer's annual federal tax liability can be reduced by $1,483. This estimate is based on 2026 HSA and FSA maximums. So as the federal maximum for these accounts is indexed each year, your potential for savings with this strategy increases annually. And that's just the short-term impact. Doug, over to you to review the long-term impact.
As an employer, you do not necessarily know when your employees plan to retire, but we do know that a workforce unprepared to retire can impact a business in a variety of ways, including higher labor costs. Typically, older employees cost more in wages due to having a lifetime of experience and cost of living increases over the years, and increased healthcare premiums. It is no secret that as we age, there is a tendency to have more costly medical expenses, which leads to higher premiums and claims. In fact, over half of large claims are from employees over the age of 55. The chart on this slide quantifies the difference in cost. The average benefits cost for someone nearing retirement is $27,300 versus someone entering the workforce at just $4,800. But there is also differences in average salary listed here. In total, the estimated additional cost to employers is $50,000 per employee per year for each year they delay retirement. Now, I know older employees provide incredible value to companies with all of their knowledge and experience. But the issue we are talking about is when you have older employees who would otherwise choose to retire, but cannot financially afford to. This demonstrates that there's not only a cost to those employees and their families, but also to a company's bottom line. Let's take a look at how that can add up for your company. First of all, 3 out of every 100 employees are at or beyond retirement age. So what happens when you multiply that $50,000 number to determine the financial impact on your company's bottom line as a result of these employees delaying their retirement over 1, 3, and 5 years? For a 100-person company with 3 employees delaying retirement, the cost for just 1 year is $150,000. For 3 years, you're looking at $450,000, and for 5 years, you're looking at $750,000. The costs are even more staggering when you look at larger companies. For a 500-person company with 15 employees delaying retirement, the cost for just 1 year is $750,000. For 3 years, it's $2.25 million, and for 5 years, it's close to $4 million. Bottom line here is that there is a significant financial benefit not only to your employees, but also to your company when you help employees achieve financial wellness so they do not have to delay retirement. But how much is enough? How much money should someone have saved in order to retire comfortably? This can be estimated based on career stages and targets of where someone should be at each stage in terms of retirement savings. For your employees in their 20s who are early in their careers, the goal is to get their savings journey underway. By the time employees are in their age 35 to 45 bracket, in what we may think of as the establishing career phase, they should have 2 to 3 times their annual salary saved. For someone making $70,000 per year, that would be somewhere between $140,000 and $210,000. What about those who are mid to late career, generally in their 50s? They should have 6 to 7 times their annual salary saved. For someone making $100,000 per year, that means they should have somewhere between 6 to 700,000 saved. Someone who is in their 60s or older is getting closer to retirement and should have at least 10 times their salary saved. For someone making $150,000 per year, that's at least $1.5 million. So what are some steps that all employees should consider regardless of the stage of their career? Steps 1 through 4 on this slide should look familiar to you as we reviewed them earlier in this presentation when we discussed the next best dollar approach to optimizing tax advantage plans. This includes taking advantage of matching contributions in an HSA and/or a 401k, then saving in an HSA, then saving in a 401k, and finally minimizing out-of-pocket costs. Employees should round out this approach by considering supplemental insurance to protect their hard-earned assets. To allow employees to take advantage of the strategies listed on the prior slide, employers should be making sure that they are offering the right combination of benefit plans. This may include automatic enrollment and escalation in a 401k, offering a high deductible health plan option with an HSA match, and an HSA vendor that makes spending, saving, and investing easy for employees. We find that some employers have designed their flexible spending account plans with contribution limits well below the federally allowed maximums. We encourage our clients to design plans that allow contributions up to the annual allowed IRS maximum amounts in order to maximize tax advantages for these benefits to both the employee and the employer. In addition, it is important to provide support to employees in terms of financial education that will allow them to navigate the plans being offered and effectively utilize the tax advantage benefits available to them. The benefits to an employer go above and beyond getting employees ready for retirement. By encouraging the usage of the strategies listed here, the employer's tax obligations can be reduced. Leveraging a HSA and 401k together creates a tax-efficient savings strategy for retirement, including both healthcare and living expenses, while maintaining flexibility and achieving investment growth. On average, HSA users save more in their 401k account than non-users. Employers may want to consider a record keeper that will integrate an HSA and 401k into a comprehensive savings experience. USI offers a robust portfolio of employee benefits and retirement plan services. We provide a comprehensive, holistic view of employee benefits to our clients. Our team of tax advantage benefit specialists focus on optimizing tax advantage plan participation and driving financial wellness for employees. We provide significant in-house resources to our clients, including compliance support and communications teams. We can help you add value and protect your business by creating a more financially secure, engaged, and productive workforce. We will be your trusted partner in helping you manage your fiduciary obligations, mitigate risk, and stay compliant with a deep commitment to client satisfaction. Thank you for your time today. If you would like to see how a tax advantage benefit strategy can unlock the maximum value for your organization and employees, please scan the QR code and you can request a meeting to see potential savings for your organization.